Hello, this is Books of the Stock Market. How's everyone doing? As for me, I ran in the snow, and the roads and the sidewalks were not cleared, causing the run to be an hour of pain and suffering. I think it snowed 5 inches overnight, and I purposely waited till 2 to run in the hopes of the road and sidewalks getting cleared, but they weren't. So I was basically slipping all over the place, and in the areas where the snow was not cleared, it was like training on sand. Like every time I took a step, my foot would just sink into the snow, causing a 50-minute run to take an hour. With that out of the way, let's talk about today's topic. Last time, we introduced open interest while analyzing the concepts of volume. This video will be analyzing the more complex concepts of open interest as well as introducing options. The first half of the video will be talking about open interest. Since this video will focus on the more complex concepts of open interest, it wouldn't be a bad idea to watch the previous video where I introduced open interest. I'll link that video in the comment section below. After that, we will talk about options towards the end of the video, so stick around till the end. Before we get into open interest, we must first define derivatives, as derivatives and open interest go hand in hand. A derivative is defined as a financial security that has its value derived from an underlying asset. For instance, call and put options and future contracts are derivatives of the underlying stock or indice. With that out of the way, let's talk about 4 basic open interest scenarios. The first one is that if there's an uptrend and there's an increase in open interest, then this is a bullish signal. The second scenario is the opposite, where if there is an uptrend and the open interest decreases, then this is pretty bearish. The third scenario is if in a downtrend and there is an increase in open interest, then this is a bearish signal. The final scenario is once again the opposite, where if in a downtrend and there is a decrease in open interest, then this is pretty bullish. Let's first talk about the first scenario where there's an uptrend and an increase in open interest. This simply means that new money is flowing into the market and they're doing some aggressive long buying. This new money pushes the underlying asset upwards. The next scenario is a bit more complicated. If there's a decrease in open interest, how is there still an uptrend? So price is only going upwards because of short covering. So what is short covering? Before we learn about short covering, let's learn about short selling, which has to be done beforehand. Short selling is when a person borrows the underlying asset in the form of a derivative so that the person can sell it at a certain price. They're selling it at a certain price in the hopes of buying the derivative at a lower price later to repay the loan. Short covering happens when you're trying to close out of your position, so you're buying back the security to repay your loan. For instance, if you're short selling at $50, you would want the stock to dip lower than $50. And let's say that the stock does drop to $40. This means you'll gain a $10 profit as you bought the stock $10 cheaper when repaying your loan. However, in this case, there is an uptrend. This means that shorts will want to get out of their position as they're losing money. This causes more buying of the underlying asset so that they can get out of their position. This buying causes the stock price to rise. Once the buying stops, the move upwards is no longer supported as there is lower open interest causing the stock to retract, and therefore this is a bearish signal. The third scenario is when there's a downtrend and an increase in open interest. This simply means that new money is flowing into the market to do some aggressive short selling, as it is obvious to the traders that the underlying asset is going to move lower. The final scenario is when there's a downtrend and a decrease in open interest. This means that prices are going to move downwards due to longs having to liquidate their positions. Longs are forced to liquidate their position because they're on the wrong side of the trade as the underlying asset keeps falling. This causes more selling, causing the stock to even fall further than it needs to. As there's less selling pressure, the underlying asset usually rises, making this a bullish signal. Moving on from those 4 basic scenarios, let's talk about more complex scenarios. So what happens when there is a sudden decline in open interest after open interest has been steadily increasing? This usually means that there's a reversal coming, as there's not enough open interest to continue the trend. Now, what happens when there is an unusually high open interest and price drops and market tops? A high open interest would mean that a lot of longs were bought as we are at market tops and people would naturally go long in an uptrend. However, what happens when price drops? This means that it forces people who bought longs to have losing positions, causing them to liquidate them. This means that the underlying security will even drop harder as longs are selling the underlying asset to get out of their contracts. Until now, we have been mainly looking at uptrends and downtrends. How about a sideways market? In a sideways market, if there's a sudden increase in open interest, then this means traders are predicting a breakout in either way. For instance, if 25,000 new positions were added, this means that there are 25,000 new longs as well as 25,000 new shorts. This means at the breakout, 25,000 contracts will be on the opposite side of the trade. For instance, what happens if there is an upwards breakout? This means that 25,000 people who sold shorts will need to buy the underlying asset to close out their position. This pushes the market even higher. On the other hand, what happens when there is a downwards breakout? This means that 25,000 people who went long will need to sell the underlying asset, causing them to close out their positions. This selling causes the price to drop even further downwards. The final interesting scenario is what happens when open interest still increases after the initial breakout. This means that it further confirms the price action and the trend is still strong. For instance, normally you should expect to see a decrease in open interest after the initial breakout as there is no more short covering or long selling. However, if open interest still persists, then this means that the demand is strong and will push the market further in the direction of the breakout. So until now, I've been talking about open interest in the context of futures, but open interest can also be talked about in terms of options. This video will merely introduce options so that everyone can have a strong fundamental understanding. So options can be boiled down to two choices, buying a call or buying a put. In the most basic terms, you would buy a call if you think the stock will rise to a certain price by a certain date. On the other hand, if you buy puts, you're betting that the stock drops to a certain price by a certain date. Again, options are complicated as you're betting on not only what the price the stock will go to, but also how long it takes to go to that price. Therefore, you need to be correct in two ways, time and price. Furthermore, if you make the wrong trade, then it's not like trading stocks where you still have the underlying stock that may have lost its value from the time you bought it. In options, your option would expire worthless, causing you to lose all of your initial investment. Therefore, you should not trade options based on only the information I provided in this video, as this video merely introduces options. Let's look at an example of a trade that I made most recently. As you can see here, this is SPY, and we see a blue line that represents the exponential moving average. I did not go over the exponential moving average, but in the most basic terms, if price is above the blue line, then it's bullish, but if price is below the blue line, then it's bearish. If we zoom into December 10th candle, we get this image. December 10th candle is the second last candle in the image. Here on December 10th, we see that price dropped and closed barely above the exponential moving average. This was interesting as up until now, price has always traded above the moving average. When I saw price dip below the moving average and saw that it would close just barely above the moving average, I decided to buy a short-term option. Here you see that I bought a put that states that price will drop to $363 by December 16th. I bought this at the end of the day. And as I saw, the price was always below the moving average throughout the day, and it was barely closing above the moving average due to the end of the day pump that usually occurs every day. This showed me that SPY was heading downwards, or at least the upward momentum was really weak. I only bought just one contract because up until now we were just gapping up and making all new highs overnight. So I did not want to risk a lot of money because shorting today's market with the Fed backing it up is extremely risky. Anyways, let's look at what happened. We see that I sold the put at open, and since the stock opened lower than yesterday's close, it caused me to profit. In summary, I made $70, which was a 43% increase. I made $70 because $2.36 represents $236 minus $1.66, which represents $166, equals $70. As you can see, options are a very versatile tool and can be very profitable if used correctly. As options can be very profitable, what tools can be used to make the correct choices? Like I said before, open interest and volume can also be applied to options. For instance, the put to call ratio is a tool that tells you the ratio of number of puts to calls. So if the call volume is up, then it means that the overall market is feeling bullish. However, if the put volume is up, then the market is feeling bearish. If the market is feeling bearish, the put to call ratio rises as the put volume, the numerator, is greater than the call volume. On the other hand, if the market is feeling bullish, the put to call ratio falls as the call volume, the denominator, is greater than the put volume. Finally, if the put to call ratio is very high, then it means that the market is oversold, while a very low ratio would mean that the market is overbought. Well, that's it for this video. I hope everyone learned as much as I did reading the book, as that is the whole point of the channel. In this video, I talked deeply about open interest and introduced options. Up until now, we have been looking at market in the short-term lens, as we have been only observing the market through daily candlesticks chart most of the time. The next video, we'll talk about long-term charts and how to read them properly. So if you don't want to miss out on these topics, please subscribe to the channel. If you enjoyed this video and felt like you learned something new, like this video as it really supports the channel. If you have any questions, leave a comment below and I'll try my best to answer the questions. Well, this is Books of the Stock Market, and I'll see you guys next Wednesday at 3 p.m. Central Time. Thanks.